Welcome to the latest edition of Fundamentals, where I'm going to look at one of the 10 most popular funds on the AJ Bell Youinvest platform right now, namely BlackRock Gold and General. The fund's mandate is to generate long-term capital growth for its investors. Co-managers Tom Hall and Evie Hambro seek to do this by putting money to work across a portfolio of gold and silver mining, commodity and precious metal related shares. The commodity is pretty compact at 47 holdings, and the 5 biggest ones at the moment are Newcrest Mining, Newmont Mining, Randgold Resources, Silver Wheaton and Agnico Eagle Mines. The 10 largest positions represent just over half of the portfolio. As we can see from this first chart, the biggest geographic exposures are Canada, the UK and Australasia. Europe, Japan and Asia, well, they don't feature at all, simply as a result of where gold deposits are found and gold miners operate. The yield is just 0.3%, but again, the point of the exercise really is capital growth. The annual ongoing charge figure is 1.17%, and for those who use such benchmarks, BlackRock Gold and General gets a 5-star rating from Morningstar. 2 final points. The fund is eligible for SIPs and ISAs, and it comes with accumulation or income units, depending upon whether investors wish to roll up and reinvest the dividends paid or bank them, such as the yield is. So those are the mechanics. The next question to address is, why would your fellow investors be deciding to take the yellow brick road right now? Well, there are 3 long-standing investment cases for gold. First, it's a traditional safe haven. Okay, with President Trump talking trade tariffs, sanctions on Iran, and berating Japan and China for currency manipulation, and that's just for starters, there's a lot to put markets on edge, and that's before we get to the Dutch, French and German elections, for example. Second, gold is hard to find, hard to produce. Supply grows slowly. This is in contrast to paper money, which central banks can create at will at the flick of a switch. Gold is therefore a potential shield against central bank profligacy and any overshoot in their attempt to target their 2% inflation goal. Third, interest rates are still anchored at rock bottom levels in the UK, while the US Federal Reserve is raising them at a snail's pace. Gold offers no yield, but then there's little opportunity cost in owning it with returns on cash so feeble. The topical twist, well, that probably comes in the form of President Trump, and every tweet about Iran or China seems to give gold a lift. The price has poked its head above $1,200 an ounce once more, as we can see from this 12-month price chart. This, by the way, is in dollars. That could help gold miners, as many have slashed costs since gold peaked at around $1,900 an ounce in 2011. Any minor increase in prices will drop straight through to the bottom line, as evidenced by UK-listed Randgold Resources and Sentiment in February. Both of them also came through with a much bigger dividend hike than expected, as did Acacia Mining. Now, not that everybody likes gold, I should say, and the case against the precious metal also comes in 3 forms. 1, it's got limited industrial use, generates no yield or cash, and thus has no intrinsic value at all, according to investors like Warren Buffett. 2, it's not strictly a cheap alternative to cash, as you may have to pay to store and insure it, if you own the physical stuff. And 3, it tends to do best when everything else is doing badly. So if the markets believe central banks will succeed in getting the economy back on track, then gold may again look like a barbarous relic, as former Chancellor of the Exchequer and Prime Minister Gordon Brown once described it. This next graphic takes gold back to 1970, and as you can see, the dollar price has had some great runs and some truly awful ones. This inevitably feeds through to the holdings of BlackRock Gold and General, and you can see its performance here since the 2011 launch of this particular share class. Whether gold is right for your portfolio will therefore depend on your specific investment goals, target returns, time horizon and appetite for risk, as well as your personal view of the world. Thank you for watching, and I look forward to seeing you next time.